Okay. Hi, everybody. This is Kevin, and I'm here with Mark. And today we're going to talk about what we're calling a tax blast. So these are just some really quick hitting items that you might be able to save some tax in 2022. Yes, I said 2022. We are in 2023. These are not incredible things, but Mark, you and I have talked before, and pilots, for the most part, are high income, but they're not rich. So the income that they're mostly getting from work is taxed, and there's a lot of tax pain with pilots. What do you think, Mark?
Yeah, Kevin, I started getting my W-2s and 1099 statements, and I'm going, oh, great, it's tax season. Let me call Kevin, my CPA, to help me out here. So that got me thinking, hey, there's a couple of opportunities that are still available for our 2022 tax year that I wanted to share with all of our aviator friends out there who are trying to do the best they can to save, invest, and lower their taxes. So some of these things might not apply for you, but we're going to touch on them all anyways. The first off is savings accounts. So if you have an HSA, which is a health savings account, really, I think it's a misnomer. It should be a health investment account. You only can use that if you have a high deductible health plan. And what are your thoughts on the high deductible health plan, Kevin?
Yeah, so a lot of people don't like the high deductible health plans, but a lot of companies are now forcing us. All it just means is that you have to pay a lot out of pocket before the insurance kicks in. But along with that comes this HSA. And Mark, I think you said it best. It's an investment account. So, most of us, when we think of medical benefits, we go, boring. We think of saving as, okay, a little bit better, but investing can be exciting. So this HSA, Mark, if I go ahead and maximize my HSA contribution for last year, what does that do for me?
Well, I think it's around $7,300 for 2022, Kevin, for a family. It's a little bit lower if you're an individual. What that does is it lowers your taxable income for this year, and it's your money. It stays in your HSA. If you leave whatever company you're with, it stays with you. You can, like you said, save it, invest it, use it for future healthcare expenses. Heck, you can even use it for non-healthcare related expenses if you pay taxes on it later. But
yeah,
it's got a lot of advantages if a high deductible health plan works for you and your family. So
yeah, the HSA is wonderful because you don't have to pay tax now. You get to deduct it against your taxes for 2022. It can grow tax free. And then if you take it out eventually and use it for healthcare, you never pay tax. So it's really getting one over on the man.
That's right.
When it comes to the HSA. So what's the next one, Mark?
The next one is a traditional IRA. And Kevin, you might say, don't most pilots make too much money to contribute to a traditional IRA? And I'd say probably most of them do. Yet there are some circumstances, and I'll give you one. I'll give you a couple. If you're a first officer at a company, you just found your dream job, you got a non-working spouse, heck, both of you might be under the income level to contribute to a traditional IRA. You might have been at that company for a few years now. And again, if you're married, your spouse isn't working, you're under $204,000, you still might be able to put $6,000 into your spouse's traditional IRA. And again, just like that HSA, that money is going to be taken off our taxable income for this year, and we can invest it and grow it and use that for our future spending. So what do you think of that, Kevin?
Yeah, so you take 6,000, you pop it in there for your spouse, and your taxable income in 2022 goes down by 6,000. So that is a great strategy. What about for people that make too much money? I always hate saying to people, you made too much money. Nobody likes that. But what about if you make too much money and you make over 204, 214 is where it all phases out. And I'll pull up the single number, Mark, as well, and give that to you in a second. But what's the issue with making too much money?
Well, if you make too much money and you still make those contributions, the tax man's going to come after you, and you're going to have to start talking to CPAs like yourself to help you get the situation rectified. Is that right, Kevin?
For the Roth.
For the Roth.
Yeah, so everything we're talking about here is IRAs. So if you go over 204 to 214 and you put money into your Roth, because that's what a lot of young pilots do. They know, I'm not making that much money. I'm young. I'll get more money into the Roth IRA. And so if you go over that 204 to 214, it's totally gone if you're married.
That's right, Kevin. So on the Roth side, that's a good point. Now, what is available if you make too much money and you still want to save for your future? And so if you make too much money, Kevin, if you're over that 214 phase out limit, the Backdoor Roth IRA is available for everybody. Now, it comes with some stipulations. If you already have a traditional IRA, then there's some tax implications about doing those conversions, but it is an option to take some money and put it into a Roth IRA account that's going to be tax-free when you go to spend it in the future.
Yeah. So as long as you follow the rules of the Roth, once you kind of max out your 401k, you get your 16% non-elective contribution, and you go over those thresholds. Next place is to do the backdoor. And again, like Mark said, if you follow the rules of the Roth, you can you can take that money out tax-free when you're retired. The single ranges, Mark, for the Roth IRA is it starts to phase out at between 129 and 144 in 2022. So for a single pilot, that might phase out. And again, you can always do the backdoor IRA, which is putting money in an IRA, non-deductible, and then converting it to a Roth thereafter. So you can do this in 2023 right now when we are, and you can get it credited for 2022. So this is the way I look at this, Mark, is every year the clock is ticking, and we lose last year's amount to get money into Roth. So we like to try to fill up last year's bucket now, and then we can fill up 2023 this year.
That's right. So we talked about retirement accounts as a way to minimize our tax liabilities for this year and in the future, Kevin. The only other category that is quickly accessible for many pilots that they think about is, hey, what about all these deductions that I used to be able to get and I can't get anymore? We've heard that question before. We know the Tax Cut Jobs Act 2017 changed the game on the federal side. However, for pilots that live in high state tax areas like California and others, there's still an option to reduce their state tax liability as well, Kevin. And I know you've helped me and some other pilots out with that.
Yeah, so that's the per diem, all the pilot things that are unreimbursed. Can't take it for federal, but California and a couple other states, you can take it against your state income tax. And, state income tax can hurt as well. So why not reduce your income there? Mark, do you have a suggestion about what to use to be able to get that data to your tax person?
So pilots at American, and I think they also cover Delta as well, is onlineperDiem.com is a good tool. I know that there's others out there probably for other employees that is a quick, useful tool that can summarize all of your per diem stuff. You can send that to your accountant, or if you like to do it yourself, you can double check your W-2 statement and make sure you're maximizing all of those deductions for your state income tax.
Right. And as we come down to the finish of this video, getting money in a taxable brokerage is always great for the future. Doesn't really help now, but right now you're a pilot, you're getting most of your income from the airline. What if you could get most of your income? And we got to bring up Warren Buffett. We've not brought him up in about 3 videos now, but Warren Buffett pays tax less than his secretary. And that's because he has all his money in a taxable brokerage account, or he just owns Berkshire Hathaway. So Mark, can you sum up the things today that we think are great for clients right now?
You got it, Kevin. So just as a recap, areas to save money for 2022 is if you got an HSA, go ahead and max that account out, and that'll save you money this year. If you are under the income limit and you're married filing jointly under 204, you can do a traditional IRA for your spouse, make that contribution. That's going to help you out this year. The backdoor IRA, the Roth conversion, that's going to help your future self is going to thank you for that one, even though you don't get the tax deduction this year. And then lastly, high tax states with your per diem, maximizing that out using other available tools out there that you're tracking all of those expenses to lower your tax for your state income tax. Those are the 4 big areas. And as you said, taxable brokerage accounts, other things are helpful tools for your future self too. So thanks for talking tax with me on this little quick hit, and we'll see you next time, Kevin.
All right. We'll see you again on the Tax Blast in the future. Thanks, everybody.
Leading Edge Financial Planning, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from these projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.